It's becoming increasingly evident that the Bank of England, BoE, is gearing up for potential rate cuts in the third quarter of this year. Whilst nothing is set in stone, there's a growing consensus among analysts that we could see the first cut as early as August, with an anticipated reduction of 25 basis points. This move is expected to address the challenges facing the UK economy, particularly its struggle to operate at full potential, coupled with a gradual approach to easing inflationary pressures. One key factor driving this speculation is the ongoing disinflation trend, especially noticeable within the service sector. This sector, which plays a significant role in the UK's economic makeup, has been experiencing a gradual slowdown in inflation rates. Recent data indicates a notable shift in the right direction. In March, for instance, services inflation stood at 6.0% year-on-year, a figure higher than both headline, 3.2% year-on-year, and core, 4.2% year-on-year, inflation rates. However, signs are emerging that this trend could soon reverse course. The driving force behind this anticipated shift lies primarily in the labour market dynamics. With job vacancies currently hovering around 30% below their peak levels and trending towards their long-term averages, the resulting downward pressure on wages is expected to translate into a moderation of inflationary pressures. In fact, recent figures show that average weekly earnings rose by 5.6% year-on-year in the 3 months leading up to February. While this may seem robust, a closer look reveals a potential easing of wage growth towards levels more aligned with the BoE's inflation target as we move into the third quarter. Yet, despite these encouraging signs, the BoE remains cautious. Whilst headline CPI may experience temporary fluctuations due to base effects, the central bank's decision-making process is heavily influenced by the trajectory of services inflation. So, what's the outlook? Whilst there may not be an immediate rush to implement rate cuts at the upcoming May policy meeting, investors and analysts alike should pay close attention to any subtle shifts in the BoE's rhetoric. As we progress through the summer months, a more dovish tone is expected to emerge, reflecting the evolving inflation landscape. With August tentatively penciled in as the starting point for the rate-cutting cycle, investors should remain vigilant for any further developments and be prepared to adapt their strategies accordingly. The UK economy is on the brink of a positive turnaround as disinflation becomes more pronounced, setting the stage for potential interest rate cuts. Whilst some challenges remain, particularly in taming services inflation, the Monetary Policy Committee, MPC, is poised to take action judiciously. As the May 9th meeting approaches, the MPC will likely acknowledge the impending decline in headline inflation. However, they are adamant about waiting for sustained reductions in crucial inflation indicators like wages before committing to rate cuts. Stay tuned as these developments unfold, shaping the future trajectory of the UK economy.